The all-important US non-farm payroll data is coming out at the end of the week, which should help mould perceptions about the path and health of the US economy. Joining me now to discuss their expectations are both Senior FX Strategist Sebastien Galy from Societe Generale and Chief Economic Advisor David Resler from Nomura Securities International. Sebastien, if we start with you, last month we saw 120,000 jobs being added to the US economy. This time the market consensus is somewhere around 160,000. What are you expecting?
We expect a negative surprise somewhere around the 110 handle. The main reason behind it is we already had the ADP print, and the ADP was actually fairly somewhat depressing and may have had an impact on the non-farm payroll forecast. However, a lot of forecasters will tell you that the ADP is a very poor lead on the non-farm payroll. Nonetheless, it may at least have had an impact, at least on some forecasters, and certainly a lot on the market, with people on the market expecting probably much below 160. I wouldn't be surprised if the market is right now pricing probably around 142, maybe 130.
What about you, David? What kind of figure are you looking for?
Our forecast is for 195,000 increase, with 200,000 of it coming from the private sector.
Okay, so you're pretty optimistic compared to some regarding the US jobs market.
Yeah, we're a bit more optimistic, but what we've been cautioning our clients about is that this is a month that's fraught with uncertainty, more so than most, because there are several competing forces that we think could be acting on this month's employment report. The weather is one that many people have argued is going to have a payback effect. The mild weather in the winter led to more measured hiring than it normally would. A second thing that we think imparts an upside risk to the employment report, even above what we're estimating, is that for 2 months in a row we had deep cuts by retailers. Yet retailers' business has been quite strong. So we think that there might be something anomalous in the measurement of employment in that industry.
What about this stubborn US unemployment rate? Are you expecting it to stay put for the moment at 8.2%?
We think it's going to stay put for now, for this month. However, we're worried that looking ahead, it may start to edge higher. And ironically, our concern about that is because we're a little bit more optimistic about the overall job market, that if job conditions are improving, and as workers begin to take note of that, some who have left the labor force will probably return to the labor force in the months ahead. Unemployed workers, for instance, would be in competition with people coming back to the workforce, as well as those who are coming into the workforce for the first time. So that would make it more difficult for the unemployment rate to come down.
What's your stance on the Federal Reserve and their current policies? Do you think they're doing enough to boost the economy and get Americans back to work?
I think they're doing about all that they can. Under current circumstances, there's a limit to how effective monetary policy can be in shoring up economic activity and demand for labor in particular. We think, given the limitations that the Fed is operating under, it's probably doing about as good as it can.
Sebastien, and the same question to you. What are your views on current Federal Reserve policies?
Well, they certainly are achieving far more than the Europeans by any shape or form, and they have been extremely aggressive in just looking at the impact of their past policy. It takes probably around 6 to 18 months to see the impact of what you've done on the real economy, and so they continue to see it peter through. It works pretty well at the end of, or in the second half of last year. They had to act once again, which stabilized markets, led equity markets higher, and helped unemployment to steadily drop. It is starting to fade, and that means the odds are that they may go for another round of QE. It has something to do with the U.S. business cycle, and probably some optimism may be fading. But it has a lot to do with the global business cycle, with emerging markets starting to slow down to some extent, which of course is having an impact on exports as well as the prices of some of the commodities which are exported out of the U.S. So that suggests that we may, by June, have the next round of quantitative easing. We're not absolutely sure which shape it will take form, but it suggests that we will go there, and that may hit the dollar in a negative fashion.
Okay, now David, there are market fears about whether the US economy will suffer another summer slowdown as it did in both 2010 and 2011. Do you think this will be the case?
Certainly the data are suggesting that kind of pattern, and there's a reason to think that it might happen, for a statistical reason to think that there might be kind of baked in the cake kind of bias in the early part of the year and a payback for that bias in the middle part of the year. But we're not convinced that that's going to be the issue this year.
David, Sebastien, thank you both very much for joining me. Now that's all for the moment, viewers, but for more news and updates on the Forex market, stay tuned to Dukes Copy TV. For the moment though, goodbye.